Welcome students. Today we will start with NCERT Class 12 Economics, that is Part A, Chapter 2, National Income and Related Aggregates. So this chapter is a numerical based chapter to calculate national income by different methods like income expenditure and value added methods, their steps and their precautions. Numerically to determine private income, personal disposable income, national disposable income and their difference. So without wasting much time, let's start our class.
Some basic concepts. Firstly, we will describe some of these concepts. So point number 1 is intermediate goods and final goods. Intermediate goods are those goods which are used either for resale or for future production. For example, milk used by a tea shop for selling tea, steel sheets used for making automobiles, and copper used for making utensils are intermediate goods because they are used as raw materials or inputs for productions of other goods. Final goods are those goods which are used either for final consumptions or for investment. It includes final consumers' goods and final production goods. For example, milk or bread purchased by household is a final goods. Point number 2 is consumer goods and capital goods. Consumer goods are those goods which are bought by consumers as final or ultimate goods to satisfy their wants. For example, durable goods, car, TV, etc., non-durable goods and service like fruit, oil, vegetables, etc. Capital goods are those final goods which are used and help in the process of production of other goods and service. For example, plant, machinery, etc. Point number 3, investment. Investment is the net addition made to the existing stock of capital. Investment can be looked up in two forms: gross investment and net investment. Gross investment, the total additions made to the capital stock of economy in a given period, is termed as gross investment. The actual additions made to the capital stock of economy in a given period is termed as net investment. Point number 4, depreciation. Depreciation refers to fall in the value of fixed assets due to normal wear and tear, passage of time and expected obsolescence. Point number 5, stocks and flow. Stock variable refers to that variable which is measured at a particular point in time. Flow variables refer to that variable which is measured over a period of time. Point number 6, domestic territory. Domestic territory is a very important concept in national income accounting. In layman's language, domestic territory means the political frontier of a country. Point number 7, normal resident. A resident where a person or an institution is one whose center of economic interest lies in the domestic territory of the country in which he lives. The center of economic interest implies two things: the resident lives or is located within the domestic territory, and the resident carries out the basic economic activities of earning, spending, and accumulations from that location. Point number 8, factor income and transfer income. Factor incomes refers to those incomes which are received by factors of productions. Transfer incomes, on the other hand, are the incomes for which no productive service are rendered. Recipients of these transfer payments do not make any contributions to current productions in return for them. Old age pensions, unemployment allowance, welfare payments, gifts are all transfer incomes. Point number 9, the concept of value added. The concept of value added is very basic to the measure of national income. Value added is defined as the difference between total value of output of a firm and value of inputs bought from other firms. It thus measures the value which the firm concerned has added by this process of production. Thus, value added equal to value of output minus intermediate consumptions. Point number 10. Closed economy and open economy. A closed economy is the one which does not maintain any economic relations with the rest of the world. There is hardly any nation which does not trade with any other nations. A open economy is one which maintain economic relations with the outside world. All the nations of the world, big or small, rich or poor, maintain economic relations with other countries. Point number 11. Net factor income from abroad. Difference between the factor incomes earned by our residents from abroad and factor income earned by non-residents within our country. That is, NFIA equal to factor income from abroad minus factor income to abroad. Factor income from abroad means residents' contributions to productions outside the domestic territory. Factor income to abroad means non-residents' contribution to productions inside the domestic territory of our country. Point number 12. Indirect tax and subsidies. Indirect tax, taxes which are leveled by the government on productions and sale of commodities are called indirect tax. Excise duty, sale tax, customs duty, etc. are examples of indirect tax. Subsidies are opposite to indirect tax. For example, if the cost of producing LPG gas is rupees 1000 and if the government grants subsidies of rupees 200, then price of LPG gas will fall to rupees 800 due to subsidies. Point number 13. Factor cost and market price. It refers to amount paid to factors of productions for their contributions in the production process. It is the cost of producing a commodity. Market price, on the other hand, refers to the market price of the commodity. It includes indirect taxes and excluded subsidies. Next, meaning of national income. National income is the sum total of factors' incomes earned by the normal residents of a country during the period of 1 year. National income can be looked upon three angles: output approach, income approach, and expenditure approach. So point number 1 is output approach. National income can be defined as a flow of final goods and service produced by the normal residents of a country in an accounting year. Final goods refers to those goods which are used either for final consumptions or for investment. Point number 2 is income approach. Final goods and services are produced by the factors of productions in the economy. Whatever is produced by the factors of productions get distributed among them as factors income in the form of wages, rent, interest and profits. Therefore, value of aggregate income is equal to value of aggregate output of final goods and service. Point number 3. Expenditure approach. We know that all income is ultimately spent on the purchase of goods and service for the satisfaction of human wants. Expenditure on the purchase of final goods for consumption is called consumption expenditure, while expenditure incurred on the purchase of capital goods is called investment expenditure. Thus, from expenditure point of view, national product is the net output of commodities and service flowing during the year from the country's productive system into the hands of ultimate consumers or into the net additions to the country's capital good. So students, the remaining topics we will continue in the next video. Thank you.